I want to talk about private equity, IPO, and public equity. When companies are very small and they're initially founded, the equity ownership interest comes from private individuals and the initial investors. For example, if we start a restaurant and I'm the owner and I put $100,000 in and I borrow $100,000 to create a company that's worth on day one $200,000, that portion that's equity is basically contributed by me, and that's my ownership interest of $100,000. And that private equity bit, being private because it's owned privately, it's not publicly traded, it's not publicly disclosed what the value of it is. It's basically private, and it's equity because it's an ownership interest. That equity is referred to as private equity. And if that company grows to become very, very large, in other words, if those restaurants expand and we start other restaurants and it ends up being a chain of restaurants, that the asset value on the left side of the balance sheet will grow, and on the right side the equity will grow as well. The ownership interest will grow, and perhaps the company will also borrow more money. But as the value of the assets grows with net income that's retained within the company, or with appreciation of the value of the restaurants or the brand, or additional new openings, and without any additional borrowing, it's the equity or the ownership interest that typically that will grow, and therefore the two sides of the balance sheet will continue to balance, and the asset side will grow and the equity side will grow as well, to reflect the value of the company and the value of that ownership interest. Now, if that company becomes very, very large, that equity interest can become also very, very large. And instead of me wanting to hold that by myself, I could take in additional private equity investors who would contribute capital to buy a stake in the company, and who would increase the asset value of the company as well, and who would also contribute to the equity capital of the company, and therefore be equity owners of the company. Now, as companies get very, very large, it no longer becomes feasible for one or a small number of equity owners to hold the equity of a company. And in order for the company to access and to tap into additional sources of capital, that company may offer its shares to the public for the first time. So a very large restaurant chain may say, the equity interest that we own today, that's privately held among a handful of investors, what we'll do is we'll make that publicly available, and it'll be traded on the stock market, and we'll cut the equity that's now in each person's hands worth millions of dollars into small tranches, and these small tranches are known as stocks. And when these stocks are offered for the first time to the public, that is what is referred to as an initial public offering. And that equity stake, that very large equity stake that's now been split into smaller pieces, is now publicly traded. And when an initial public offering takes place, it doesn't mean that the original investors sell all of their stake, although they may sell some. They might also take in additional capital from new equity investors who will invest in the form of the publicly traded shares that are now available to everyone. So instead of me in my restaurant offering perhaps some equity interest to a friend or neighbor in return for some capital, now the company has its shares listed openly on the market, and that additional capital contribution is coming from investors that are active in buying and selling securities on that stock exchange. And those might be private individuals or mutual funds, or even if the stock is ultimately included in index funds or hedge fund managers who buy the shares and then become equity owners of that company. So we can see how a company and its equity portion of its balance sheet, the equity interest, the ownership interest, goes from being privately held, in other words private equity, through an initial public offering to being public equity. In all cases, it's equity and it's an ownership interest, and it goes up and down with the performance of the company and the value of its assets. And in the difference being that private equity is held in the hands of a few private equity investors, often being the founders and close parties to the founders, and public equity, which is then held by many and traded on a public equity market.